Welcome back, dear students and scholars. In the previous video, we learned the basic cost flow methods under ASC 330. Now we are going deeper into LIFO, which means last in, first out. At the surface, LIFO sounds simple. Newest costs go to cost of goods sold first. But in real reporting, LIFO is not just one formula. It is a cost layer system with layers, liquidations, pools, dollar value calculations, reserves, tax conformity, disclosures, and controls. So today our goal is not just to calculate LIFO, but to understand how LIFO behaves over time. LIFO has more moving parts because the method does not stop after assigning the newest cost to cost of goods sold. Each year, layers may be created, reduced, or liquidated. Inventory items may need to be grouped into pools before the calculation even begins. The tax election can affect external financial reporting through the LIFO conformity rule, and users need disclosures about reserve balances and material liquidation effects. That is why we separated this topic from the cost flow overview. LIFO is like a filing cabinet. The front drawer looks simple, but the back folders need serious organization. Here is the path for this video. We will begin with a quick LIFO refresher, then build the stack using a base layer and later increment layers. After that, we will study decrements and LIFO liquidations, including their income effect. Then we will move into pools and dollar value LIFO, where the calculation shifts from physical units to inventory dollars. We will also cover price indexes, double extension, link chain indexing, LIFO reserve, conformity, disclosures, and controls. Valuation tests such as lower of cost or market come in the next video. Let us refresh the basic logic first. Under last in, first out, the newest costs acquired are assigned to cost of goods sold first. Older purchase costs remain in ending inventory and may stay there for many years as layers. This is a cost flow assumption, not a physical movement rule. The company does not have to physically sell the newest goods first. The accounting assumption simply says current sales use the most recent costs, older costs remain in inventory, and each period can add a new layer to the LIFO stack. The base layer starts the LIFO stack. When a company first adopts LIFO, the ending inventory at that adoption date becomes the base layer. In the slide example, the adoption year is 2026. Ending inventory is 1000 units. The unit cost is $20. So the base layer cost is 1000 multiplied by $20, which equals $20,000. This $20,000 layer anchors the LIFO stack. It remains intact as long as ending inventory stays at or above 1000 units. If the inventory level later falls below that amount, the base layer may be partially or fully liquidated, and that reduction is permanent. An increment creates a new LIFO layer. In 2027, ending inventory rises from 1000 units to 1250 units. The increase is 250 units. Those 250 units are costed at the current year cost of $24. So the new 2027 layer is 250 multiplied by $24 or $6,000. The total LIFO inventory after 2027 is the base layer of $20,000 plus the new layer of $6,000, giving $26,000. Each layer keeps the cost level from the year it was created, so layers do not blend into one average number. A decrement removes existing layers. In 2028, ending inventory falls from 1250 units to 1100 units. So the decrement is 150 units. Under LIFO, the most recent layer is removed first. So the reduction comes from the 2027 layer. That layer originally had 250 units and is reduced by 150 units, leaving 100 units. The base layer remains fully intact. A key point is that layer reduction is determined at year end. Interim movements during the year do not automatically create a final LIFO liquidation. LIFO liquidation can lift income in a rising price environment. When older, lower cost layers flow into cost of goods sold instead of current higher costs, cost of goods sold becomes lower than it would have been under current cost. The slide formula is effect equals units liquidated multiplied by current cost minus layer cost. Here 150 units are liquidated. Current replacement cost is $27 and the layer cost is $24. The income effect is 150 multiplied by $3, which equals $450 lower cost of goods sold. Lower cost of goods sold means pre tax income is $450 higher. That is why analysts care about LIFO liquidation disclosures. Now, let us connect the 3-year unit LIFO case. In 2026, the company establishes a base layer of 1,000 units at $20, giving $20,000. In 2027, ending units increase to 1,250. So a new 250 unit layer is added at $24, giving another $6,000 and total LIFO inventory of $26,000. In 2028, ending units fall to 1,100. The company removes 150 units from the 2027 layer, leaving only 100 units from that layer. The 2028 LIFO stack is the base layer of $20,000 plus 100 units at $24 or $2,400. Total LIFO inventory is $22,400 and the liquidation income effect is $450. Pools make LIFO practical. If a company has thousands of stock keeping units, tracking each item as a separate LIFO layer can become almost impossible. Pooling solves this by grouping related inventory items together and performing the LIFO calculation at the pool level. This reduces volatility, handles product changes more smoothly, and makes record keeping more manageable. But pooling cannot be random. The pool must follow valid business logic, such as similar use, similar processing, or similar cost behavior. If management creates pools only because the spreadsheet looks nicer, auditors will probably not be impressed. Natural business unit pooling is one accepted approach. A company with distinct operating divisions, product lines, or business segments may define separate LIFO pools for each business unit if the units operate independently and produce separate financial results. In the example, Apex Appliances has a kitchen equipment division and an audio devices division. They have separate processes, cost structures, pricing behavior, and customer bases. That supports separate LIFO pools. The important idea is that pool boundaries should follow business substance and documented operations, not merely the organizational chart or administrative convenience. A company may also use multiple pools by grouping inventory items with similar characteristics. Similarity can be based on processing method, interchangeability, similar use, industry practice, or product line cost behavior. More pools may improve matching because layers stay tied to more specific inventory categories. But more pools also increase record keeping because each pool needs its own layer schedule, index calculation, and annual reconciliation. Management must balance precision with practicality and document the rationale clearly. A good pool is like a good classroom group project. The members should actually belong together. Dollar value LIFO tracks dollars instead of physical units. This is useful when a company's inventory mix changes frequently because of new products, discontinued items, or substitutions. Instead of tracking each unit, the company values the pool at current cost, converts that amount to base year dollars using a price index, compares the result with prior base year layers, and then values increments at the appropriate layer index. The key formula is Base year cost equals current year cost divided by the price index. Once base year dollars are known, the company can determine whether an increment or decrement occurred. The price index separates price change from quantity change. Without the index, an increase in ending inventory dollars could mean the company has more inventory or simply that price has increased. LIFO must distinguish between those two. In the slide example, ending inventory at current cost is $132,000 and the price index is 1.10. Dividing $132,000 by 1.10 gives $120,000 of base year cost. If the prior base year balance was $100,000, then the real increment is $20,000 in base year terms. The comparison must always be made in base year dollars. The double extension method builds the price index directly from inventory quantities. First, list the ending inventory quantities. Second, extend each quantity at base year unit prices to get the base year total. Third, extend each quantity at current year prices to get the current year total. Fourth, divide the current year total by the base year total. In the example, $132,000 divided by $120,000 gives an index of 1.10. This method is precise when the product line is stable, but it becomes heavy when new items appear because every new item needs a base year price. Precision is good, but not if the accounting team needs a time machine to find every old price. The link chain method updates the index each year. It solves the product mix problem by computing a current annual index using items present in both the current and prior year end inventories. That annual index is multiplied by the prior cumulative index to create the new cumulative index. The formula is new cumulative index equals prior cumulative index multiplied by current annual index. In the example, the prior cumulative index is 1.10 and the annual index is 1.036. Multiplying them gives 1.14. That cumulative index is then used to convert current year ending inventory into base year dollars. Each year's index links to the prior year, which is why the method is called link chain. Now let us apply dollar value LIFO across 2026 through 2028. In 2026, current cost is $100,000. The index is 1.00. Base year cost is $100,000 and LIFO inventory is $100,000. In 2027, current cost is $132,000 and the index is 1.10. So base year cost is $120,000. That creates a $20,000 base year increment valued at the 2027 index of 1.10 or $22,000. Total LIFO inventory becomes $122,000. In 2028, current cost is $125,400 and the index is 1.14, giving base year cost of $110,000. That is a $10,000 base year decrement from the 2027 layer, valued at the 2027 index of 1.10. So $11,000 is removed. Final LIFO inventory is $111,000. The LIFO reserve shows the inventory difference between a non-LIFO basis and the reported LIFO basis. The formula is LIFO reserve equals non-LIFO inventory minus LIFO inventory. In the slide example, $132,000 minus $122,000 equals a $10,000 reserve. If the reserve increases by $4,000, the entry is debit cost of goods sold $4,000 and credit LIFO reserve $4,000. When the reserve increases, cost of goods sold rises and income falls compared with a non LIFO method. Analysts often add back the LIFO reserve to approximate FIFO inventory for comparability. LIFO also has a tax conformity connection. Under Internal Revenue Code section 472, a company that elects LIFO for income tax purposes generally must also use LIFO in its external financial statements. Supplemental non LIFO information may still be provided in notes or schedules, and internal management reporting may use a different basis. But the primary external financial statements generally need LIFO if the company wants the tax benefit. Changing away from LIFO requires careful analysis of tax consequences and accounting effects under ASC 250. This is one of the few areas where tax reporting and financial reporting are tied together very visibly. LIFO needs strong reporting controls because errors often hide inside the layer records, not in the final inventory total. The company should document the LIFO method, pool definitions, and index approach in its accounting policy manual. Management should approve pool structures with a clear business rationale. Layers should be reconciled annually to source records and the general ledger. The LIFO reserve should be computed, documented, and compared to prior periods. The company should identify material liquidations before the financial statements are finalized, and disclosures should reflect the method, reserve balance, and material liquidation effects. LIFO without controls is not an accounting method, it is a suspense novel. Let us review common LIFO mistakes. First, do not treat LIFO as physical flow. It is a cost flow assumption. Second, do not forget liquidation effects when ending inventory falls below prior layers. Third, do not mix unit LIFO logic with dollar value LIFO logic. Unit layers and base year dollar layers are not the same thing. Fourth, do not define pools without documented business substance. Fifth, do not miss the income statement impact from reserve changes. Sixth, do not skip the disclosure review. LIFO becomes manageable when the layer map is visible and the controls are working. Here are the 6 ideas to carry forward. First, LIFO assigns the newest cost to cost of goods sold first. Second, the adoption year inventory becomes the base layer. Third, increments add new layers at current year costs. Fourth, decrements remove the newest layers first and may create liquidation income. Fifth, pools and indexes support dollar value LIFO when item level tracking becomes impractical. Sixth, the LIFO reserve, tax conformity, and disclosures require formal controls at every reporting cycle. In the next video, we move to valuation and estimation methods under ASC 330, including lower of cost and net realizable value. If this lesson helped you understand LIFO beyond the formula, please like the video, subscribe to the channel, support the course, and share it with colleagues who are learning US GAAP. I will see you in the next ASC 330 lesson.